Happy 2026 and welcome to my January market update. I'm Valerie Leonard, founder of EverThrive Financial, and today I'm going to share some key insights so that you as an investor can make informed and confident decisions on the path to growing and protecting your money. This month, we're going to be looking at insights to guide your investment journey into 2026. We're going to go over some key themes for the coming year, including everything from AI and gold, bonds, and what's happening across the globe, and what is likely to potentially drive market gains in the future. And in the end, we're going to examine some important components of a solid investment process so that you can compare what you're doing now to EverThrive's unique investment process. We've got a meaty discussion today, so I invite you to join me for the next few minutes so that you can get the full picture of what may be ahead for 2026. And there are some important lessons that we can learn from 2025. So I just want to start off with a look at asset class performance last year. And so when you look at this chart, look at the blue arrow in the center of the slide, and you're going to see how companies of different sizes performed in 2025. In the top right corner of the one table with the blue arrow, you're going to find that large cap growth companies returned 18.6% last year. Now, you may be wondering what this means or maybe even what a large cap growth stock is. So just as a quick reminder, large caps are companies that are worth over $10 billion in market cap, and they're often known for stability, for lower volatility. They often pay dividends. So I want you to think about a company about the size of Amazon or maybe Walmart. They're generally going to be very large in size and often a household name. And then in contrast, a growth strategy highlights companies that are expected to grow earnings faster than perhaps the overall market. So they're often known for returning profits to investors in the form of share price growth when the stock price goes up, hopefully. And then they generally don't pay dividends to shareholders. So that top right-hand box where we see the performance of large cap growth stocks, that's where the 18.6% 2025 positive performance data comes from. Now, if you move over to the left in the top left box of that same chart, you're going to see large cap value companies returned 15.9% in 2025. Now, a value-oriented company tends to appear cheap relative to their peers or their financial statements, and they're typically more mature and stable than, say, a large cap growth company. And then the blend column in the middle represents companies that are considered both growth and value plays. Then on the next row, you're going to see mid cap value, and those companies are generally going to be worth between $2 and $10 billion in market cap. So think of a company maybe like the size of, say, Texas Roadhouse, for instance. And you can see mid cap growth, blend, and value performance there. And then the row below that represents small cap stocks, which are smaller companies with high growth potential, but often greater risk and volatility since they can be more sensitive to changes in the economy. So you're likely not going to recognize the names of small cap companies because they're smaller in size and not usually a household name. But the bottom line here is that all major asset classes had positive performance last year, and all small cap and large cap stocks outperformed their 10-year annualized returns, as we can see by the table to the left of the table that we just reviewed. Now, switching gears to sector performance. In 2025, this tells a story about which areas of the economy perform the best. So communication services and technology continued to dominate, but even the lower performing sectors still had modest gains with the exception of real estate and maybe consumer staples. But overall, US stocks, which are represented by the S&P 500 index, were up over 17% in 2025 from a price per share perspective. And you can compare that to a 23% gain in 2024 and also a 24% gain in 2023. Now, one thing to note, the S&P 500 came very close to reaching an all-time high last week of 7,000, and the Dow surpassed 48,000, and gold moved above $4,500 per ounce recently. So these are pretty important psychological levels to pay attention to. And some factors that drove market performance last year include things like the fact that energy costs fell throughout the year, particularly oil, which went down to about $56 a barrel at its lowest. You already know that interest rates fell last year. We watched inflation closely. And so while prices across a wide range of goods that impacted consumers did increase, the overall levels of inflation did stabilize. So those higher prices ended up lowering consumer confidence, but the rate of growth of inflation helped provide some balance. So these are just a few factors that led to solid market performance in 2025. And so the next takeaway from looking back at last year is to examine the trend. Now this chart goes way back. It shows a 20-year look back at the performance of the S&P 500, taking us all the way back to 2006. And you can clearly see the upward trend is solidly in place, but that doesn't mean that we haven't had sell-offs along the way. So with the exception of the 2008 market crash, the majority of the time, those sell-offs were relatively short-lived in the grand scheme of things. Now I've circled on the far right, the sell-off that we experienced last February, and that's where markets tumbled pretty quickly, but they recovered by the month of April. So while you'll see that times like, say, 2022 here featured more of a sideways moving market for the entirety of the 2022 calendar year, these periods remind us that history can teach us that staying the course often pays off for those investors who can put their emotions on the shelf and wait out any corrections. But then when we zoom in and we look at the past 3 years of S&P 500 performance, you're going to see that the sell-off in February of last year does seem pretty big, but it was also quick. It lasted only around 8 weeks. So my advice to those of you that get nervous about market sell-offs is to work with a professional that can help guide you through these periods of uncertainty. Now, the next takeaway from 2025 contains lessons learned about the big companies who are getting bigger. Now, we've talked a lot last year about the Magnificent Seven. These are the 7 stocks that are some of the largest out there. So companies like Google and Amazon, Apple, Meta, Microsoft, Nvidia, Tesla. When you take these 7 companies and you add the 3 next largest companies, which are AMD, Palantir, and Broadcom, you're going to find that these 10 companies together collectively represent nearly 41% of the S&P 500's makeup. So in other words, the performance of the S&P 500 is largely dependent on only 10 companies, whereas the other 490 companies in the index represent the remaining 59% of the index's makeup. We call this concentration risk. So if something major happens to one of the big 10 companies, it will likely dramatically impact the performance of the S&P 500, which leads to increased risk for investors. And diversification in this case is, of course, always going to be important, but even more so heading into 2026, because concentration risk is a bigger risk in investor portfolios than it has been in years past. Another key takeaway from 2025 is that it's important for investors to continue to separate politics from investing. 2025, wow, there was probably no prior year where we saw such massive change all at once to the political and policy landscape. Yet the market continued to rise. And here's another example of that. Last week, all eyes watched the conflict in Venezuela, yet the market marched higher last week. And this is yet another reminder that political events across the globe or here locally should not be the primary driver of investment decisions. This chart on the screen is one of my favorites. It shows major world events dating all the way back to 1870 and the impact of major events or even conflicts on the stock market. So this includes periods like the Great Depression, all major 20th century wars, the Cuban Missile Crisis, and in more recent years, the COVID pandemic and the conflict in Ukraine. You can see that the markets have always historically gone up after any temporary drops that were caused by domestic or world news. So while your emotions may be running high over what's happening in Washington and throughout the globe, history teaches us that patience can potentially benefit us over the long run. And finally, wrapping up our look at last year, the last major takeaway from 2025 is that corporate profits continued to hit record highs, thanks in part to the AI build out. Now, tariffs also were the hottest topic of market discussion really in the first half of the year, but AI led the conversation in the second half. And AI is largely responsible for positive gains in the market in the third and fourth quarters. And we are off to a strong start in 2026, as you can see in this chart. But heading into 2026, I just want to caution you that it's important to balance AI enthusiasm with awareness about all of its hype. There are so many AI plays out there, and they all can't possibly win. But I suspect we're going to see more winners rise to the surface, and we're going to see increased risk and volatility in the remaining players. But the topic of AI is not going away. And it definitely leads into key themes that we are watching on behalf of our clients and investors overall for 2026. So for the year ahead, we will continue to watch the Fed as inflation falling will likely continue to create a supportive interest rate environment. This chart shows market expectations for the federal funds rate going into 2026. Now, it's important to note that we're likely going to see a period of disinflation in the first half of the year, and that could possibly lead the Fed to cut rates further than what's even shown on this chart. And we do expect a potential forecast of continued economic growth. So that's good news. And for those of you that are interested in better understanding how we measure economic growth, you're going to want to pay attention to GDP. Now, GDP is just simply a measure of all the goods and services that are produced within the United States. And this chart reminds us that 68% of GDP comes from consumption, meaning the more that we consume as Americans, the more our economy grows. 13% of GDP is derived from business investments, and then 19% from government spending. And that government spending component is what's going to affect fourth quarter GDP results, obviously, because of the shutdown. And when GDP is reported, it may seem a bit lackluster the next few releases, thanks to those lingering effects of the government shutdown. And I don't believe that this is going to be cause for concern. It's just something to be aware of, as it's going to affect headlines. And depending on how the media chooses to spin it, it may seem a little bit unsettling. But just keep in mind that economic data releases are always backward looking. And so these reports really shouldn't be a surprise. We're going to continue to update you in the future if anything changes, and we'll definitely be watching this data closely. Another big potential theme for 2026 is related to international markets, which outperformed US stocks in 2025. We had a great stock market in 2025 here domestically, but international markets did even better, posting over 33% in gains. Now, here you're going to note that the EFA index, so that's an index of 21 developed market countries. It includes countries like Europe and Australia, New Zealand, Hong Kong, Israel, Japan, and Singapore. So the EFA index was up nearly 32% last year, whereas the Eurozone was up over 41%. And then emerging markets that are still not yet fully developed, those were up about 34%. So potential opportunities in international markets may continue. And here at EverThrive, we are strategic about overweighting in less speculative or maybe even more strategic global markets while still maintaining broad international exposure. And we also think that we're going to see attractive yields in bonds with capital appreciation potential if rates continue to decline. Now, current yields as of the end of 2025 ranged anywhere from 3.47%, as you'll see here on this chart for the 2-year Treasury, to as much as 4.84% for 30-year Treasuries. And then on the chart to the right, it shows year-end yields for the U.S. aggregate bond market, which is just a basket of bonds. You can see those yields. You can see yields for investment grade corporate bonds, for high yield bonds, municipals, and so forth. And then finally, due to geopolitical tensions and also demand from central banks around the world, we do expect gold to remain strong. It's no surprise to you that gold and other industrial type metals are benefiting from a global realignment where countries and investors are really increasingly moving their assets into forms of wealth that aren't controlled by any single government, and also that are potentially less susceptible to any political influence or even currency fluctuation. So this is something that we're going to be watching closely here at EverThrive. We'll monitor this on your behalf, and don't forget that the trend could reverse just as quickly as it started. And so while we can talk about sectors and stocks and bonds and the potential outlook for the markets and the economy all day long, I do want to remind you of something that I think is even more important than the data that I've shared thus far. And I want you to walk away from today's video knowing that a robust process is the foundation of wise investing. So having a robust investment process can help take the emotions out of investing. Very few smart investment decisions are made when someone is panicking. So having a process helps prevent that. And a process also helps strengthen risk management. Upsides and gains, those are great. But without risk management, an investor can face possibly even higher downside losses or tax consequences. And so we want to make sure that we're thinking about risk management when we're building and monitoring portfolios. But finally, a robust process also helps you take advantage of potential opportunities. Your process should help you identify opportunities and really better position you for hopefully benefiting from them. So this brings us to our process here at EverThrive. So what does it look like? What's the brief version at least? So first of all, our research is fueled by multiple research tools and resources, and we emphasize both quantitative and qualitative metrics. So what does that mean to you? Those are some big words. What it really means is that we start with the universe of investments. We narrow it down to the securities that we choose for our clients based off of so much more than what the average investor looks like. And it also means that we're not just looking at past investment returns and expenses. Now, of course, performance and expenses are often a top focus for clients, and they are also very important to us here at EverThrive as well. But on top of that, we also emphasize having a robust risk management process, kind of like what we just talked about, that's going to help incorporate an analysis of how our clients' holdings may have performed in bad markets as well as good markets. Also, our client portfolios are built with their personalized goals and their risk tolerances in mind. But every financial advisor typically does that. So what's unique to EverThrive is our use of model portfolios and a model portfolio trading platform. So while many financial advisory firms build custom portfolios for each and every client account, we build custom models for our clients. And this platform and this process helps us blend standardization with the personalization that our clients want and need. It helps us do a better job of aligning our clients' portfolios with one another, and it helps us better keep our hands around what our clients own in their accounts. And it gives us the ability to follow a more robust process for buying, for selling securities across our entire firm and on behalf of our clients, as opposed to just being forced to trade each client's account one by one. We can pay closer attention because we're able to narrow down that big universe of investments, and we can apply a more consistent investment process to a smaller number of holdings. And it also gives us the ability to be more flexible when potential opportunities or even threats arise. And it lets us trade multiple client accounts at once. So of course, we're going to pay attention to the market. We're going to pay attention to economic conditions and the data that's out there, as well as market behavior. But this all helps us overweight client portfolios to potentially take advantage of areas that we think may overperform in the coming 12 to 24 months, while also underweighting areas that we think may potentially underperform. So our intent is to build a core model portfolio based on each client's risk tolerance, customize the model based on our clients' unique goals, monitor the investment holdings regularly, work to make sure that our clients are diversified, and leverage a flexible trading platform for consistency and also efficiency. So one final note behind our process is what I believe is our true superpower at EverThrive, our people. The EverThrive team is a group of experienced professionals who are talented, passionate, caring, and they love what they do. They love supporting our clients. So on that note, if you're not yet a client and you'd like to learn more about working with us, scan the QR code that you see here on this slide, or you can call or email us at the number or email address that are here on this screen. But while you're doing that, just keep in mind that we can help you manage your investments. We can provide rollover guidance for your employer-sponsored retirement plans, your IRAs, your Roth IRAs. And we also offer comprehensive financial planning solutions, everything from retirement planning, tax strategies, estate planning. We also offer life and long-term care insurance and policy reviews and much, much, much more. So thank you so much for joining me today and for subscribing to our YouTube channel. And also, thanks for sharing the video. We will see you here again next month, and I wish you a continued happy and healthy start to 2026.